I'm Alice Murray, the editor of The Drawdown, and thank you very much for joining us today on our webinar looking at fund financing, finding your perfect match. I'm delighted to be joined by Mohith Sondhi from OakNorth and Emilio Spiezio Sardo, who's from Bluegem Capital Partners. I'll hand over to them. I'll hand over to them in a second for a quick introduction. But just to tell you a little bit about what we're going to do today. So obviously we are exploring fund finance, and to do that we're going to look at a real life case study. So we're going to look at a subscription line put in place by OakNorth and secured by Bluegem that took place over the summer. And we're going to find out from both the lender and borrower perspectives as to what each was looking for in their ideal partner. We'll hear about how Bluegem determined their funding needs, what they were looking for, and how OakNorth assessed the management team, track record and portfolio. And then we'll also discuss kind of the various fund finance solutions available in the market right now, and what kind of managers and portfolios they're best suited to. Yes, as mentioned, my pleasure to be joined today by two excellent panelists. So Mohith, hello, very welcome. Thank you for joining me today.
Hi, Alice. Pleasure to join.
If you could just give us a quick kind of background as to yourself and OakNorth.
Hi there. Yes, so I joined OakNorth about 5 years ago from RBS. I've been with RBS 16 years. I started my career in project finance, then moved to leverage finance. I joined OakNorth basically at its inception in April 16. The bank was co-founded by Rishi Khosla and Joel Perlman in 2015. Rishi and Joel were serial entrepreneurs. They did their masters at London School of Economics together. Rishi went to go and head up the family office for the Mittal family. Joel went to go and work for McKinsey's looking at outsourcing. A few years later, they met up again and decided they wanted to start their own business, started an equity outsourcing research business. Knocked a number of investment banking doors, and Deutsche Bank gave them a weekly contract. They got a couple of interns from London School of Economics, and that's how they started Copal. That was going well for 6 weeks, and they got a fax through saying that, look, we love what you do. Can we go and have 450 people by Monday? Joel gets on a plane to India, sets up operations. Fast forward 10 years, 3,500 people globally across 5 continents, 18 of the world's largest 20 investment banks as clients, credit funds, hedge funds, private equity as clients. And this is a business they started with £40,000 peak capital, and they sold it in 2014 for about $800 million. So how does that translate into a bank? And they were both at the grand age of 38 at the time. So during their growth period, they went to HSBC and Barclays in the UK and said, look, we want an overdraft for £100,000. Can you help us? Both banks took 6 months to come back to them and said, actually, we'll lend you the money, but we want a PG in your matrimonial homes. Joel pointed out, I'm not married, I can't give you something I don't have. Rishi pointed out that HSBC, the investment bank, was a client, and if they paid them on time, they wouldn't need the overdraft. And then they had the same conversation with Citigroup in New York when they were setting up offices, and Citigroup wrote them a check for $10 million. And it sort of sowed the seed that the UK's got, I would say, 5 banks that predominantly dominate the market, including Santander, and very good below $1 million, very good above 25 million, very inconsistent between 1 to 25 million. So they went to the regulator and said, look, we're entrepreneurs, we're not bankers, we'd like a banking license. We think that there's a real need in the market to help these growth companies between 1 to 25 million pounds. The regulator was empathetic, the guys bankrolled it. And they got the license in 15. We lent our first pound in October 15. And I said, I joined in April 16, and we had a loan book of £10 million. Fast forward, we've lent £4.5 billion in the last circa 5 years now. We do 4 asset classes: property investment, property development, fund finance, and corporate funding. I look after the fund finance part of the business for us. And we've seen some great opportunity in that, and look, we'll talk about it in a moment. But you know, it's interesting because as the world sort of closed and seized up, I think alternative lenders like ourselves become more relevant, and borrowers what they're looking for in this environment is consistency and being able to execute and being transparent where you are. So that's pretty much it.
Excellent, thank you. Fascinating story. And Emilio, over to you.
Thank you, Alice. Great to hear the story of OakNorth. I knew a little bit, but not in such detail. So, no, listen, on Bluegem, it's a private equity fund, London-based. We got established 13 years ago. I am one of the co-founders with background in Merrill Lynch investment banking 21 years ago in M&A on a pan-European level. Then I joined an hedge fund in 2005, and then after a couple of years, we created the Bluegem with initial focus on mid-market company in Europe. Fund number one was 200 million. Fund number two, 370. We're raising a fund as we speak in excess of 400 million. Fund number one was more a generalist sector approach. Fund number two became already specialized in branded consumer goods. Fund number three kept the same sector focus, but narrowing down to the more stable, consumer stable branded categories. We are investors in across Western Europe. We cover 7 geographies from UK to Iberia to Italy, France, Benelux, Germany, Nordics, and we typically implement 3 programs in a portfolio company that we buy: digital transformation, international expansion, especially with focus on China and United States, and new product development through our in-house digital agency, which drive, idea for new product development. So that's the focus of the fund. So, and myself, I'm one of the co-founder, and I'm involved in the origination, execution, and management of the fund and the platform. That's for me. And
brilliant, thank you very much. Okay, so 2 very qualified speakers. And on to the matter at hand. So today we're aiming to keep our session fairly short and swift. So we will run through the, as I mentioned, the fund finance facility that was secured over the summer, and then talk about the market more generally. To the audience, if you've got questions, please do feel very welcome to ask. You can use the Q&A function down at the bottom of your screen, and then as we get towards the end of the session, I will feed your questions through to our lovely panel. Okay, so kicking us off, I'm going to start with you, Mo. Can you tell us a little bit about the subline that we're going to be focusing on today?
Yeah, happy to. So look, we were approached, I would say, probably May, June time by Bluegem Partners, saying that, we have a client looking for a subline. It's at the smaller end. A lot of the banks are closed and funds are closed at the moment. There's no one really in the market. Can you help us? We're finding it challenging. And challenging because of the market as opposed to the underlying credit quality, because obviously we wouldn't have done the deal if there was an issue with that. And to be fair, so we had a good chat with Kieran, and Kieran went through it and said, oh, absolutely, to us, the size is irrelevant in that respect. Yes, we were set up for, growth companies between 1 to 25 million pounds. But what we also found is that in the fund space, no one really looks at a deal, I would say, below 15 million pounds. It's very hard to place a deal below 15, and even tougher through COVID and lockdown. So Kieran approached us and said, this is the transaction, this is what we got. We said, actually, wow, looks really interesting. Looks really good. There's a lot of work to be done. We've got to understand this, and it's not just about the LPs. Subscription facilities. We've always said that you just don't underwrite the LPs. You have to underwrite the underlying investments, because logic says is that, or rationally, that no one's going to follow their money if they don't believe the investments are valuable. And I know the market will always say, oh, we had no institutional defaults in this space, so it's great. But there was no institutional defaults in the CDO space before that crashed and burned in 2007 and 8. So you can't use that herd mentality that, oh, there's no defaults here, we'll just do the credit underwrite and the LP and we'll be okay. So, like I said, we did a deep dive into the LP, but we also do a deep dive into the underlying investments and the management team. And we've got the capability to do that in very short order as well, and that quickly. And that's what we did. So we put the facility in place. We'd met Emilio before, to be fair, the institution a couple of years ago. We'd looked at some funding some of the underlying investments. So we knew of them. And the more we went through the process, the more impressed we were with what business they have, what they needed. The requirement was very, very sensible. It was well structured, well put together. The information that Emilio and his team had was excellent. And that's one of the key things that we've learned through COVID is having top quality information and transparency. And that's on both sides. They were very transparent with us, what would work. And we were very transparent with them, what would work for us as well. And therefore, within, I think the first meeting, we got the deal done within about 4 weeks, actually papered and done and drawn. So considering where the market is at the moment, a subline can take anywhere from 3 to 6 months, which really doesn't help the fund in itself, because they need certainty of funding right now. So that's what we did. That was our first subline at that point in time. But to be fair, we've seen some great traction since that point. There's a number of other funds that we're talking to, and again, it's at that lower level where, unfortunately, a lot of the banks that play in this space just don't get out of bed for a check lower than 20 million pounds, predominantly.
Neither do I. Wait. So thank you. And then Emilio, can you tell us what was going on with you? Whereabouts were you in your fund life? And it sounds like you went to talk about your need, but then also kind of sounds like you went to Marlborough to get some advice on.
Bluegem is now managing a racing fund number 3, and this is de facto legacy portfolio for number 1, which we manage as well. It was a fund, to be honest with you, as Mo said, the amount of liquidity was extremely limited. We're talking about 3 million pounds, and that was the size where most of the banks were uninterested because it was too little. At the same time, it was an extra caution we wanted to get navigating through the Brexit. And actually, to date, these 3 million are still sitting on our bank account. We had a portfolio company not ask for it, but for us, it was good to have the flexibility to use the cash in case it was needed. And the main driver was a bridge to an asset disposal. We are selling an asset, and we thought it was not good for the LPs to call equity if there is a close event of an asset disposal. And given our cost of capital of our shareholders being substantially higher than the cost of the facility, it would have made sense. That also coupled with the low administrative burden that this sub-facility are at the moment having, especially the machine of OakNorth, which is quite lean, thorough, but lean and flexible at the same time. So in a nutshell, it was a liquidity facility, at the moment not even used, to bridge an asset disposal. That's in a nutshell. I confirm what Mo was saying. We appointed a debt advisor, Marlborough, which is probably one of the market leader. They contacted the several parties. There were a couple of parties interested, but eventually speed was also important, and OakNorth was faster in the due diligence, less bureaucratic in the approach, but at the same time thorough and deep in the due diligence, both on the credit of the investor, but also on the underlying assets. And that's how we managed to de facto close the deal in 4 weeks. So.
Excellent. Okay, so then sticking on this due diligence point, obviously speed was really important to getting this done, but Mo, I can imagine from your side, as you mentioned, it's really important for you to get comfortable with the manager and with the fund. So how were you able to do that due diligence so quickly? yeah, how did that work? What was it that got you so comfortable?
Yeah, so there's two parts of the OakNorth business. One is the bank, and on one side we have a fintech platform which we outsource to various other banks so they can use as well. So in that respect, we use a lot of technology behind the scenes to help us underwrite and look at each individual credit. But we also use the human side of it as well. So the technology doesn't dictate an underwriting response, I would say, but it definitely helps us and makes us quicker and better and slicker and more consistent in underwriting as well. And that's the one thing that I've seen. It's been a tremendous help to us, but also to our clients as well. And we share that analysis with Emilio and so forth. So, like I said, it's a very thorough, detailed process, but we can expedite it, within a few days, as opposed to my previous experience. It can take a few weeks. And again, it can be very inconsistent as well. And we're sharing knowledge between us and the borrower, because we have to be open to the fact that we will not always be right, and there may be some better information sources that Emilio may have that he will share with us, and we'll absolutely use that as well. The other key thing I'd like to bring out there is that we also bring our clients into credit committee as well to present the case. So Emilio was co-presenting with me, so there's no sort of Chinese whispers. There's no opaqueness in our process, where they're in the room with our credit committee and senior members of the bank, talking through the proposal, and they hear the questions, the context of it, and so forth. Because I think there's nothing more frustrating for a borrower when they go to someone, any institution, and they say, yeah, we'll get this done for you, and they come back and say, sorry, we haven't been able to do this, or we've got this approved instead, and they're scratching their head going, what happened? What did you ask? This is completely different to what I wanted, and I have no understanding. And I think, personally, I think it's a great experience.
Fantastic. Okay. And then, so, let's talk about what actually was decided on and how it came about. Emilio, you've given us a bit of a detail there that it was used to bridge an upcoming exit and obviously ease that kind of burden on your LPs rather than doing a call and then a distribution. So can we get some details on kind of how it was structured, how it worked with your LPs, kind of what you needed to communicate to them?
Yeah, I mean, obviously we took some buffers on the liquidity event of the exit, given the uncertainty of the market, we didn't know about the pandemic at the time, but obviously about Brexit. So we allowed, let's say, a couple of years to our investors, saying, listen, I mean, let's buy a couple of years before calling you this money. So let's put in place this facility to give it 2 years to dispose of these assets. And they simply did the fact of comparison analysis of what would have costed for them the facility vis-a-vis their internal cost of capital, and they eventually decided that also were in their interest to take. I have to say that the amount of education for the LPs and sponsored LPs with this facility is increasing over time. There was more skepticism. I've been, user of this facility for a long time, for the last 5-6 years, but I see more and more education about this product. As long as obviously they are short-term product, they cannot replace long-term equity capital, but on a short-term basis, bridge to an exit disposal, bridge to future capital call, that's a relevant use of the instrument, especially if you are dealing with an organization quite efficient without an excessive burden of administrative tasks. That's another point also important. And that's it. There was a due diligence thorough on the asset. I have to say, was quite intense. In addition to the due diligence of the credit rating of the LPs, both due diligence work streams were equally important. But at the same time, it was done in a very expedite, efficient manner, as opposed to leaving a lot of gaps and a lot of time wasted throughout the process. So You can be both. You can be thorough, but also efficient as well. That's vis-a-vis the process.
Excellent. Yeah. Thank you. And Mo, on your side, when it came to structuring this facility, was it pretty clear cut, kind of given that Bluegem and Emilio had quite a specific need in what they wanted, or were there various options or ideas that you had?
Yeah, the facility was relatively clear cut, to be fair. You know, as Emilio said, you know, we knew the purpose, we knew what the security was. The key challenge was doing the diligence and expedite that, and doing it thoroughly enough to make sure everyone's comfortable with it as well. And also setting up the relationship for the future. So it wasn't just about just doing these facilities, really understanding Bluegem, what do they want to do, and to try to, you know, position ourselves for future deals with them. Because, you know, as Emilio said, you know, they've got a number of funds and they've got another number of banks involved with them. So, you know, whether it's at the investment level or at the fund level. So for us, you know, it was a very thorough piece of work. The structure, you know, was relatively straight. And, you know, we had some great lawyers work for us, as did Emilio and stuff, you know, which really helps to diligence the LP stuff. But again, for us, it was also understanding the credit there as well of the LP.
Super. Okay, so after what sounds like an incredibly rapid yet thorough process, obviously the line was put in place over the summer. Emilio, you mentioned that it's, you know, the key thing is that it's bought you some time. It's given you a lot of headroom for a couple of years. It's saved your LPs a lot of admin and probably is pretty cost effective thing to do, especially kind of given the market. Is there any other kind of impact for you? Does it mean anything else? I don't know, for instance, is there additional reporting requirements? Is there additional administration on your side, or are there further benefits? You know, that headroom, does that give you extra cash to deploy if you want or need?
Well, there is additional reporting requirements. There is additional admin, but they're quite reasonable. Obviously, we have CFO of the fund. The CFO is reporting on a quarterly basis to the equity, to the LPs. So we had only to adapt and integrate the LP reporting with additional questions, but they were within, I mean, a reasonable request. But we assessed those admin tasks, and we felt, I mean, still the opportunity is worthwhile, given, I mean, also the extra admin requirements. But there are obviously, I mean, there is a reporting that the CFO is doing to OakNorth on a regular basis. It's quite detailed. But once you put in place for the first time, it becomes almost, not say automatic, but it's much more manageable in the future.
And it sounds as though from the information and transparency you were able to provide OakNorth on setting up the line, that your house is in order when it comes to reporting and information.
Yes, that is a crucial part. That is a crucial part. I have to say that was dealt immediately in the interaction. They were very clear on what they needed for due diligence, what they needed going forward, and that also expedited the process, because we understood their needs, their requirement, and we put in place due diligence material for them, and more importantly, reporting standards going forward. But once, if you are clear from the outset, then the relationship gets much smoother. Because the overall objective is really to establish a long-term relationship and a partnership. And then from one side, I think we need to provide the right number, the right metrics. On the other side, they provide more flexibility with the ongoing requirements. So that's the two-way partnership.
And Mo, just, you know, thinking more broadly about when you're assessing other opportunities in the market and looking to work with other funds and GPs, how, you know, what difference does it make when that information piece is there and you're, you know, that level of transparency and order is in play?
I think it's massive, I'll be honest. I think in this market, if we don't have the information or transparency, we just wouldn't do a deal. You know, it's the reality of it all. You know, we need to be open with each other, especially through these difficult times. Emilio's team were excellent. You know, we clearly set out what we wanted and they gave us everything we needed, to be fair, and there wasn't any real pushback on it. You know, sometimes it's, you know, they have the right to ask us question, why do you need it? And as a lender, we have to be able to answer that, why do we need it? It's not a nice to have, because it's a very difficult environment we're in. So we shouldn't be requesting stuff for the sake of requesting it. And I think that was important. And that's what helped at the start, as Emilio said, that helps build a relationship, because then they feel that we're asking pertinent questions and we're asking for stuff that we really need, and that we're not just asking for the sake of it, or we're delaying things, or, you know, we don't want to move this forward or whatever. So it works very well. But I would say with any client that we're talking to at the moment, we're very clear on what we need. And if they can't produce it, we need to understand why. And if they just don't want to give it to us, we just walk away. You know, we don't need to do a deal in this environment.
Fair enough. Super. Okay. So let's look ahead to next year. Obviously, market conditions are going to be as they are for some time, it seems. Mo, you mentioned that, you know, since doing this deal, you're very busy and you're looking at more. What do you see as your main kind of focus over the next 6 to 12 months?
Really good question. I think there'll be a number of funds out there that are smaller in size, that have never raised a subscription line, who will be looking to raise subscription line for additional liquidity just to get them through. They may never even draw it, to be fair, but they'll want some sense. And I think their LPs will be open to that now, where previously they were like, actually, we don't want any leverage of any kind. You know, everyone was expecting NAV facility to be a raft of NAV facilities to come in place in Q3 this year. It just hasn't happened. And my personal view on that is that's because the banks at the moment haven't started showing their teeth with the underlying investments and requiring more cash. And I think once the banks suddenly show their hand and saying we need more support instead of kicking the can down the road, I think the funds will be forced to go down the NAV route. But also I think some of the funds have been quite smart as well, because they are drawing down LP money for future bolt-on acquisition. So I think that's a better story to go to the LP saying, actually, we're not going to pay down bank debt or put this in portfolio companies just sitting there as cash. We're going to go and acquire because we think that there's multiple arbitrage here as well. So I think there's a number of things going on. But I think in Q1 next year, I think there'll be, you know, I think there'll be a flood of activity. We're seeing a lot more ourselves coming through. I think the larger lenders are still reluctant to do, I would say, pure new business. I think they're focusing on their existing books, which is right so as well. You know, they've got a big client base to service and manage and prioritize. So from our perspective, I see this as a great opportunity to do
Super. Yeah, I couldn't agree more. I had some information from a fund finance advisor, Vardy Partners, who estimated that there's only been around 15 NAV facilities put in place this year, despite lots of attention and talk around them. Okay, and then so Emilio, what does the future look like for you, kind of with now that this line is in place? And I mean, probably I'm looking much further in the future. Do you, now that you've got a subline, does this make you more open to various fund finance products, maybe a NAV or a hybrid?
We have a subline in each of the three funds. As he said, the LPs don't like these instruments beyond 12 months. So in any case, it's a short-term optimization of liquidity. So that is one requirement. For us, it's mainly used either to bridge upcoming sales or to bridge, to accelerate signing and closing. Sometimes in very competitive process, you want to go full equity without having the risk of refinancing the portfolio company in order to win. So you might need to raise subscription line. We're using now subscription line when raising a new fund, not to call an excessive amount of cash from the first closing investors. So these are for us the three utilizations. So either bridging upcoming sales, or accelerating auctions and go full equity and funding us with subscription line, but for a short-term period, or if we have a fundraising, de facto avoiding an excessive burden of liquidity call from first-time investors. I believe there will be always demand for these three use of this cash. There is more and more awareness by the LPs, as long as it's considered as a short-term option, as opposed to long-term replacement of equity called. That would be acceptable. Now, facility is something we have not considered. Likely the fund did not need it. I agree with more what is happening on the market at the moment, that the banks, for the moment, are on a wait and see mode. They're not that harsh on portfolio companies, so there is more breathing space than what we originally thought at the beginning of the pandemic. Let's see what's going to happen in the next few quarters. So situation is very fluid with that respect. But I agree, I haven't seen many now facility being placed for this reason, because the banking attitude was more benign towards this pandemic.
Mm-hmm. And sticking on facilities, we've got a question from the audience. Why was this facility structured as a subline over a NAV facility?
Mo, you want to answer yourself, or?
It's a good question. I suppose from our perspective, there's obviously more comfort having subline because of the quality of the LPs there. Could it have been done as a NAV facility? Absolutely, but then there's the cost element to that as well, and then it goes back to what Emilio says, is that actually it's got to be cost efficient for Emilio to do the deal. So actually, what's the best way to do it? Actually was through the subline, because it makes more sense from an increases return. You can absolutely do a NAV facility, but the cost is very different, and therefore then it's marginal whether you do the deal or not. So that's what it was. It boils down to that, but the quality of the portfolio was such, yes, a NAV facility can be done, no doubt about it, but it's much more cost effective doing it structured the way we did it.
I would echo the answer mostly for cost.
Okay, yeah, that's interesting. They are very pricey. And just to be clear, there's a second part to this question about whether or not OakNorth would look at NAVs, and I think you mentioned there that you would.
Yeah, we've done them actually.
You've done them.
So we've done a number of them. I think actually we're very good in that space because we can do the underlying risk assessment very quickly. Whereas I think the challenges a lot of the banks have is that if they go to their fund finance team with a NAV line, is that the NAV really needs to be looked at someone who understands the underlying, and we can do all of that. Like I said, my background is leverage finance anyway. I can do that within our team. So I don't need to pass it on to another team. So it can fall between two stools. So that gives us, I think, a competitive advantage on others. But yeah, we've done a number of NAV facilities. We're comfortable in that space.
Super, okay. And what about something like, sorry, I'm just going to throw it out. What do you look at, I guess another product that's really gained popularity this year has been preferred equity. Is that something you consider?
Not really. I mean, I think it's a bit blurred what's preferred equity, what's NAV. I think it's down to leverage level and what you want to raise, in my view. I personally, OakNorth isn't set up to do preferred equity. That's a different kind of risk.
Agreed. Super. All right. So I think that gives us a very nice and detailed overview of this facility that took place, why it was done, how it was done, and what it means for both of you, which is fantastic. And we've thought a little bit about the future, about what that is looking like. So I think what we'll do now is I'm just going to turn to each of you for some kind of concluding remarks. And what I'm looking for specifically is relating to the subline itself, working together. What were the key elements that got it done, that were important to the success of this particular facility and your relationship going forward? And then kind of any observations you think would be relevant or interesting to the audience in terms of how to tackle the next 12 months or so from a fund financing perspective. So Mo, I'm going to throw this one at you first.
Okay, look, from my perspective, it's relatively simple, as we discussed. It's transparency and communication. And Emilio and the team were excellent at doing that. You know, very clear what they wanted. We were very, very clear what we needed. So that helped get the deal done, and they had everything to hand. I think my concluding remark going forward for funds would be, sorry, can you?
Your sound's a little bit tinny. I think you're.
Sorry, am I back now? Is that better?
Yeah, you're kind of.
Is that better?
You're just a bit. It's like you're just a bit far away.
So I'll keep this short. So what I would say is, for funds, you know, looking at their financing needs for the future, I would have those conversations sooner rather than later, right now, as opposed to when you need it at that point in time. I think that's a different conversation. At the moment, there is liquidity in the banking markets, but my view is that liquidity will seize up next year, because when banks start to sort out their own balance sheets, they're going to suck liquidity away. And if you do need funding and you know you need it for Q2, Q3, Q4, you should absolutely be having those conversations. That doesn't mean you need to conclude your financing arrangements, but you should be having.
Super. So yeah, just to recap there, get ahead of your fund financing needs, speak to your lenders now, really think about what you might or could need over the next 12 to 18 months.
It's exactly that. Exactly.
Cool. Thank you. And Emilio, your kind of concluding key remarks.
Well, I think we discussed most of them. I mean, in a nutshell, it's transparency and communication. I would agree with Mo. I think fair cost. The cost of this facility has to be fair, in line with the market. The administrative burden has to be reasonable. And then overall, the focus on relationship, a long-term relationship, as opposed to tactical deal making, which also include flexibility of ongoing requirements, problem solving. So these I would assume are the 5 or 6 ingredients to a good relationship.
Perfect. And that was exactly what we were here to talk about today, creating that perfect relationship between lender and borrower. It sounds like we do have a match made in heaven here. It's great. So on that very cheesy note, it is Christmas after all. I'm going to wrap things up. So a huge thank you to Mo and Emilio for joining me today, for sharing their insights and their fascinating story around this subscription line. Of course, as always, a massive thank you to you, to the audience. I hope this was of interest. We will, of course, as always, have a follow-up online and in the magazine with a write-up of the key points from this discussion, and you will be able to find the recording as well if you are looking for something to do over Christmas. So on that note, I will let you all get back to your busy days. Thank you very much for watching.
Thank you.